Welcome to Investors Insights. Our topic today is 2 out of 3 ain't bad. Why did we choose that topic? Mr. Page, I'm going to give you credit here. You made a point in our meeting, which was pretty intense today. Talk about all this news media that's coming at people, information about the economy. Talk about it.
Yeah, they're talking about the jobs numbers being off, but as we were talking this morning, that's only one of the three, to Greg's point. It's jobs number, it's wage growth, and it's productivity growth. Those are all three very interconnected. So we're seeing a lot of stuff on the February jobs number being down. The wage growth and the productivity growth that candidly has been the problem, and we've been missing it, is the best in a decade.
Right.
So you can't just focus on the job numbers being down. You got to look at the other two also together.
So is this where I say bad news sells? Is that, they focus on the bad news?
Exactly.
But there's plenty of good news. Also at the same time though, we got an anniversary here, Bobby, which that's been a news highlighter as well, 10 years.
Yeah, so last week the market celebrated its 10-year bull market anniversary, but it's important to point out that it hasn't consistently gone up for 10 years. I mean, technically there's been 3 bear markets the past 10 years. Bear market is defined as a 20% pullback in one of the indexes. So in 2011, 3 indexes fell 20%. 2015, the Russell 2000 small cap, and then NASDAQ fell 20%. And then last year, 2018, the small Russell and then also the NASDAQ fell 20%. S&P was very close at 19%. So it has not been a consistent, it's been a volatile 10-year bull market.
So is this where I say that based on the headline, our jobs would have been a lot easier if it had just gone like this?
Yeah, exactly. Instead of the roller coaster that we actually have.
Yeah, there's a reason there's more gray here.
Yeah.
Right? Well, maybe actually less hair.
A lot of ups and
as
downs.
well. Yeah, so clients need to understand.
Amazing how quickly people forget. U.S. debt downgraded in 2011. The oil prices 2015, and then it was just a quarter ago we were down 20%.
Yes.
How quickly we forget. In 10 years, there's nothing happened.
Sure. Yeah, it's just straight up, no problem.
Exactly.
Yeah, let's go. So let's also talk about jobs.
Yeah.
Jobs being a topic that Ashley brought up. You brought it up as well, Adam. Talk about this.
Yeah, last week, we talked about jobs growth. We wanted that to be our X factor. We wanted that to be our driver. Well, the report came back, it wasn't as good as we thought.
Right.
Expected 180,000, we got 20,000. So, we had a lot of good job growth in the last few months. I think that's made our expectations kind of rise. It's put us in a position now where I think expectations are going to start to lower, which is a good thing. If we beat those expectations, we could see this volatility start to fade away and maybe get a little boost in the markets.
Okay, so this is where in our meetings, I pull back the curtain here. So what? Who cares? Jobs. So what? Who cares? Why do our viewers need to be aware of the job news?
Yeah, I think what's important on the jobs is it's an indicator of just health of the economy. Good companies hire, bad companies fire.
Okay.
But what's also big is what Ashley pointed out. It's not just hiring; it's wages. As people run out of job openings, or they're trying to get new people, they've got to raise the wages. That's great. New people get higher wages. They can spend that money. That's an indication of health or productivity. Companies are making more money. So I think the jobs number is important because it shows consumer sales and possibly consumer confidence, which goes to the bottom line of companies in the market that we see.
Well, and that's why I appreciated you guys bringing that up because, people say, why do I need to know that?
Right.
I mean, what's that in relation to my portfolio? But if companies are not hiring, if they're not making money, chances are their stock price is not going to go up. Agreed?
Agreed.
Yeah,
It's
agreed.
a great early indicator, and that's why we like to watch it each month because companies slow down their hiring well before they report bad earnings.
Right. Right.
They're gonna do that kind of behind the scenes. So what's important to see is this an indication of future poor numbers, or is this a one-off? And it's also important to remember that the jobs number is a survey, a government survey with an error of either plus or minus 100,000 jobs. So this will get revised, and so with the wage numbers being good, I think we expect that it'll be revised higher. And then what's also big is that the consumer confidence numbers from month to month, that's a leading indicator. The consumer jumped in confidence from January to February. So if people aren't getting hired, they're likely not confident. So this bad number that everyone's reporting, that Ashley kind of pointed out, had good wages and good productivity, not really a bad number, or this bad number that was below expectations, really probably was a one-off and not really an indicator of bad job
And it
hiring.
causes the volatility, like Bobby talked
Exactly.
about over the 10-year period.
Yep.
Yeah.
exactly.
So yeah.
And we also had, average hourly earnings went up 3.4% year over year.
That's not bad.
No, that's
for
good.
consumer confidence, I mean,
Right.
that gives a little boost there too.
Right.
Yep.
And on that note as well, talking about jobs in the future, we are going to be talking about a trend that we're seeing. Ashley brought it up in the meeting about robotics. I want you to talk about that, and then I'll elaborate. Go ahead.
Sure. Robotics purchases in that industry in small and medium-sized businesses in 2018 by far set a record. You never historically saw a lot of robotics in that space. It was mostly in large manufacturing, mostly autos, because robotics mainly used for material handling, things like spot welding that you would see in an auto manufacturer.
Right.
Now you get a lot of small to medium-sized businesses. As the prices have come down, they're buying robotics, which gives more productivity, which gives more wage growth. It's all linked.
Right.
But it was major growth in many different industries other than automotive last year.
Right. Okay. So on that note, what we're saying here is unemployment's at an all-time low, correct?
Correct.
But one of the things we're looking at in 2020 is robotics may become a topic in job replacement for people. It won't be because the economy slows down. It'll be because technology has advanced. And we're going to continue to watch that trend. So the point I want to make here is that you can look around the table and see that everybody here has a face for radio. And the real reason we're giving you this information is we want you to take this data and we want you to be able to use it in your conversations and dialogue, as well as to sleep at night in knowing what trends are out there. And as we look from a historical standpoint, we also look at the present with jobs reports, productivity. So we've looked at 10 years, we're looking at the current, and also what does the future hold and what trends do we need to follow so we can bring that to you to be able to track your portfolio and the impact these events can have on it. So we hope you have a great week. We're thrilled that it's spring forward, more daylight out there, and we hope you enjoy it and sleep well at night. And just know we're going to keep our eyes on this market, and we appreciate your confidence and belief in us. Have a great week.